Hey everybody, Kimosabi here. Happy New Year. Had a nice break from charting so much. Figured I'd let the holidays chop this out. And now let's get back into business. I'm bringing you the Ichimoku cloud today just because I keep tabs on it. And I happen to notice on the daily, I've kind of been watching that entering into the cloud. So this kind of sort of supported on the cloud. And I was wondering if this was going to break out of the cloud and stay above and have the cloud as support, as to not give you an edge-to-edge trade, which is down to 84,000 from that area. It ended up supporting above it, but now it's back inside, and it actually closed the daily right inside of it. So it's like sludge. It ends up being like a resistance zone, and it slows down price. It slows down progress up and down when you're in the cloud. But ultimately, this is an edge-to-edge trade from here down to probably here. Let's say 87,600 or so. That is a valid trade as long as that daily candles are closing within the cloud. You need to get back above the cloud, start closing daily candles above the cloud, say 100,000, to be out of the cloud, and then you would probably support it. So that is something bearish. That is a potential. So just for shits and giggles, let's mark off that bottom of that cloud, because any flat zones in the cloud end up being supports and resistances in the future, so it's always good to be aware of them. So price does not have to go down there, but to me it kind of makes sense that it does go down there. With these equal lows, all this liquidity over here probably gets taken out, revisits this area. Like I was saying in my previous video, the wave 4 of lesser degree, which I was counting as being that, would be a target, which is a 50% retrace. But let's do a quick Elliott wave count. We'll take off the cloud. So we'll get the trend-based Fib extension tool, measuring from the August low, counting 1, 2, 3, 4, 5 for our leading diagonal. Retrace for a wave 2 right there, projecting the wave 3 target at the 1.618, which was hit beautifully so far. That was 106,300. Wave 5 target should be 130,000, but first we have to complete the potential wave 4. So let me label that for you. Oh. Looking something like this. 1, 2, this would be 3. 4 is somewhere in this area, but I suspect it's probably down here. And then you have a shot up for wave 5. This is in linear scale, not log scale, because that's the way I do my Elliott wave counting. So after hitting the 1.618 Fib extension of a potential wave count, or any impulse, you expect some kind of retrace, and that seems to be what we're getting now. So if I am to count this as a wave 2, I want to see the Fibonacci retracements like I had in my previous video, from low to high, from that wave 2 low. So I'm just measuring wave 3 and getting the retracements. Common retracements for wave 4 is the 382. We bounced on that really well, popped up, and 0.5 is also a common retracement, which just so happens to line up with the bottom of that Ichimoku cloud target for the edge-to-edge trade, which I find very interesting. If we can zoom in, just expecting this correction to be wave 4, we could zoom into the 4-hour and get a little more intricate in the price details. So here on the 4-hour, all-time high, currently 108 something something. Price came down, sold off very, it was different than other sell-offs. It was very persistent, whereas these were just quick flushes. This was kind of a quick flush. This seemed to be very persistent. So it might fill out a range for a while. We might be bouncing around there for a little bit, unless if we're going to go attack that 0.5 and take the Ichimoku cloud trade setup and this Elliott Wave trade setup that's kind of going on. The way that I had this was some kind of ABC up, ABC down, probably a 1, 2, 3, 4, 5 up. So that's like an expanded flat. And if that is the case, we can measure that. We can measure waves ABC, projected from the low of a potential B wave, and getting into a pocket where you'd expect the expanded flat to go. So you'd count that as being A, B, C. Looks pretty clean. And if that is a completed correction for this persistent move down, then maybe this leg down can resume, and then you would get yourself some kind of weird A, B, C. Your target should, in Elliott Wave terms, be like 86, but it might only be 87. Let's take some measurements. We'll see where it may or may not land if price does break down there. Let's measure that down to there, project from the high. So the 100 fib extension gets you to 86,775. So maybe you fall short of it. Maybe it pushes past that Ichimoku cloud target. Maybe it reaches past the 0.5 fib retracement of wave 3. It's a target if it comes down that way. What I'd be interested in, if price does decide to come down there, I'd like it to match this leg, to look like this leg. Be very persistent in nature to give you a good buy setup down there. So essentially what I'd be suggesting is this leg is matching this leg, and you'll have minimal retrace. You might get up to like 98 for a sell setup, maybe previous resistances, and then get that follow through leg down to 92. And 92 might just look like an ABC buy setup. However, due to the liquidity down below, I would expect this leg to repeat right there for a bounce back up to the point of control, and then follow through with the rest of this leg down to target. It's kind of what I'm looking at. Where would I say that I'm wrong about that? I'd say anywhere above 100,000. If price closes 4 hour above 100,000, I would say that invalidates this leg and it's doing something else. If price does come up there, watch for a quick sharp move down again to grab those liquidities before resuming up. There's a pattern that I did notice that can match that. I'll show you in a second here. So the pattern that I was kind of looking at that kind of goes up from here, sort of, but choppily, is matching this leg with this leg. They match okay. They're not great, but they're okay. And this leg here would be matching this current leg, which then you repeat this in reverse and then flush down again before popping back up and taking the highs, and then back down, and up. So you'd be kind of trending up very slowly, just mimicking what we did there, and this is your kind of the center of it as a correction, and then you have this moving up before ultimately blast off. It'll just be a base that kind of builds higher highs and higher lows throughout. That is if price does make a higher high. Price does have to get up there though. But with the Ichimoku cloud, closing within that Ichimoku cloud and currently getting a 4-hour lower low, you kind of expect a lower high to come in. And it might be just repeating that leg down, grabbing this liquidity, which makes sense. Another thing that makes sense is after a markdown, like price coming down like that, the liquidity providers and market makers do what is called a 3-phase market cycle to maximize liquidity in this whole area as like a reaccumulation. So what you tend to have is some kind of choppiness, right? You take the lows, take the highs, flush the lows. And that is your 3-phase market cycle. You got a 1, 2, 3. And that provides maximum liquidity to clear out this range. Because you'll notice that the volume comes at the extensions of all of these peaks and valleys. That's where business is being conducted. So based upon what price is doing, the liquidity providers slash market makers slash whales in this market, they just look like they're swinging above the highs, and swing failure pattern both times. Swing failure, swing failure, swing failure, and then reaccumulation back into markup phase. Which brings me to Wyckoff. I was thinking of this being an accumulation range, which would make sense. That's the way I was looking at it. And so far, it looks good. But we popped up on the high. This would be an upthrust. But you're back inside the consolidation. Usually what happens when you're back inside the consolidation, you find resistance becomes resistance again. So that would be like 99,500. You may find resistance there. You may also find resistance at these local peaks here at 98,900, somewhere around there, 98.99. Maybe a quick wick, but no closures above this box. I would see this as your reaccumulation formation, where you have your selling climax here, preliminary support, selling climax, automatic reaction, secondary test. There's your upthrust, and maybe you come down for a spring. And as I put in my previous video, the target for the spring is roughly 87 to 86,000 based on the height of this formation. So the optimum way to buy Wyckoff is you want to wait for an uptrend to start out of the spring, and then your stop loss can go there. But ultimately, you want to get it back inside this consolidation. So you have the spring, and then the show of strength, and then you stay above 100K from then on. And that would be your sign of strength, backup phase to retest 99.5 before markup phase. This spring down, this didn't really look like a spring to me. This did look like a secondary test, especially with the volume profile. The way the volume didn't spike up high enough. I wanted to see it almost get to these previous volume spikes, but not be quite as high. If you had volume like that following through, you'd likely enter into a markdown. But you have volume here on your upthrust, and now you're getting volume pushing price back into this consolidation. So it speaks to me to say this is probably going to take out the liquidity down below. It just makes sense. You should see a volume spike down. If price does make it down to 87, 88,000, you should see a volume spike that is similar to these volume spikes over here, but not quite as high. And then you want to see some buyback volume. You want to see a big volume spike as it comes back inside the consolidation to tell you that they're done with their business down below. Now they want to go up above. One more thing I thought I'd mention. What about the cycles? I don't count the days myself, but I use the cyclic lines to denote the cycles. And here we have 30 days. So each one will be a 60-day, just count 2 of them. And we have either a cycle low or a mid-cycle low. That should come in on that date, which is actually the 11th or 12th of January. So I'm wondering if January 5th would be too early for the daily cycle low, or if the 12th could be considered within the timing window of a cycle low, hitting lower targets. So those are my thoughts. Yeah, watch for the sell setups. Watch your liquidity. If price does come down to 92, expect a bounce back up to the center of the range, probably where it's at right now at around 96, 95, and then come down and break the lows. That's kind of what I'm watching for. But if price does start closing higher highs, especially on the daily, then you're in an uptrend, my friend. You currently do have a higher high close than that one. That one is a higher high, and you would expect a higher low to come in somewhere around 95,000. So there's some hope there. But out of this area, you'd need to close a higher high on the daily, because there's 2 or 3 components to a trend. That would be a higher high, you want a higher low, and you want a subsequent higher high. And then you keep buying the higher low, higher high, keep your trend going up. But for right now, you have this low on a weekly. This is lower, and this came in that much lower. We could measure that out to see how much lower that was. From that low, we'll go on closing price, and we'll bring it down to the closing price right there. And then we'll project it from the closing price up there. And that's where you should find your lower high. And that worked. So now we have this area right here. I'll zoom into here, where we have that closing a higher high. So where would you find the higher low? Right around this area. 95,485, which price is about to get there. So we'll see if that area holds. If not, look for 92, then a bounce, and then a break of the low. I hope those various methods of looking at the charts were helpful. Yeah, always keep your stops tight so you can have a good night.